Tots, toys, tips.
Every parent wants to provide the best for their little one, and when it comes to saving, it's a bit of a minefield. So in this video, we'll look at the two different types of JISA, the cash JISA and the stocks and shares JISA, and give you a few pointers on how you can save for your little one's future.
This video uses examples throughout. They're not recommendations, and this video does not constitute advice. If you require recommendations specific to your or your child's circumstances, seek independent financial advice. Junior individual savings accounts were brought in 2011 to complement JISAs that have been available to adults since 1999. There are two types: a cash JISA, unsurprisingly allowing savings to be held in cash, and a stocks and shares JISA, allowing investments in securities like shares, funds and bonds. They're both tax-efficient savings vehicles, which means that no tax is payable on any interest earned or growth on the underlying investment. The subscription limit is currently a whopping £9,000 per year, meaning that if your child is lucky enough to be given a significant amount of money, there's a huge tax break available here. They're available to anybody in the UK who's under the age of 18 and who was born on or after the 3rd of January 2011 or doesn't have a child trust fund account. They must be opened by a parent or legal guardian, but can be paid into by friends and family, and many providers make it very easy to do this, meaning that birthday presents and Christmas presents can be paid directly into their account. The money within a JISA belongs to the child, and ultimately they can do what they want with it when they access it at 18. This has the benefit of parents not being able to dip into it, but also friends and family knowing that the child will definitely receive any money they give them. Let's take a quick look at the pros and cons of each type. So cash JISAs are a great option if you or your child are very risk adverse. The pound value of your cash JISA will never go down. They're particularly suitable for short-term savings. If your child is closer to the time they might need the money, then holding savings in cash is usually a good idea. There are lots of providers in the market for JISAs, with practically every bank and building society offering them, so they're often very quick and easy to set up. They're also protected by the Financial Service Compensation Scheme, so if the organisation were to go bust, you'd still get your money back up to £85,000 at the moment. On the flip side, however, particularly in the current market, savings in cash are unlikely to outperform inflation. That means in real terms, whilst the pot might grow, you won't be able to buy as much in the future as you could buy with that money today. A little bit more on that later. And similarly, your savings are unlikely to grow as much as they might do if it was invested in the stock market. For the best deals currently and a lot more info on cash JISAs, take a look at Martin Lewis's website, Money Saving Expert. It's a fantastic site that's always kept up to date with the best deals in the market and a lot more. When it comes to stocks and shares, there's opportunity for much greater returns, and in the long run, the investment will likely outperform cash and inflation. However, there's also a real chance that the value of the pot might drop. In the short term, the value of the pot may fluctuate significantly, and this can cause some investors concern. As a result, they're only really suitable for longer term investments. If you're slightly more risk adverse, the risk of the investment within the JISA can be altered by choosing suitable funds that meet your risk appetite. But all of this does mean that they're slightly more complicated than just storing some cash in an account, and may not be suitable for everyone. However, I believe that with a little bit of reading, everybody should be able to make an informed decision and get comfortable with how they work. So how might the two types of accounts perform? This graph comes from an article by City AM, which shows very clearly the differences between holding £1,000 in a cash JISA in blue versus a stocks and shares JISA in red over the course of 18 years. This conveniently paints a picture to represent what might happen if you start investing when your child is born. The graph also takes into account inflation, so it shows the buying power rather than just the pound value of the pots. You'll see that whilst there was a relatively strong growth in the cash JISA from 1999 until 2008, it's actually not too different from the stocks and shares JISA. It's a very different picture from 2008 until 2017. During this period, cash interest rates had really dropped, but inflation had stayed pretty strong, and as a result, the buying power and value of the cash in the cash JISA in real terms actually went down. You can also see that whilst there are some significant drops in value of the stocks and shares JISA, for example in 2001 due to the dot-com bubble bursting, and in 2008 due to the global financial crisis, there are also a number of significant jumps, and overall the general trend is upward. The result is that the final value of the stocks and shares JISA is significantly higher than the cash JISA despite those drops. One thing is true, whatever JISA you choose, and that's the sooner you start, the better. Einstein described compound interest as the eighth wonder of the world, and here I've tried to show exactly why. In both scenarios, £7,200 is invested over the course of 18 years, and to make things simple, I've kept a consistent interest rate of 4%. The green line shows the value of the pot as it grows with an investment of £50 a month from the baby's birth, versus the yellow line showing £100 a month investment, but only starting when the child is 9. Despite the same amount being invested, the account that was opened earlier has almost £3,000 more in it when the child is able to access it at 18. This is purely because it's had so much longer to benefit from the cumulative effect of compounding. Time in the market always beats timing the market, so start saving as soon as you can, however little you can deposit. When it comes to choosing a provider for a stocks and shares JISA specifically, there are a few things you may want to look out for. Unlike a bank account or cash JISA, where they're essentially free, you'll have to pay a small annual fee to the organisation providing the account, often in the form of a very small percentage of the value of the pot that's invested. These fees are one of the few things within your control when investing, and they compound just like interest does, so over time they can really add up. Keep them as low as possible by finding a good value provider. Different providers have different requirements for the amount that needs to be invested. Some have an initial investment minimum, and others have a minimum monthly contribution. Find one which suits your needs. Some offerings have lots of bells and whistles which you might find useful. A decent app goes a long way nowadays, and you might want to know that they have good customer service or that friends can easily pay into the account. Once you have the account open, set up a direct debit to pay into it if you plan to contribute regularly, and ensure that the money gets automatically invested in your choice of investment. This set and forget approach is a great way to be surprised at the value of the pot when you eventually look at it in a few years' time. The example here is from Fidelity, for which I'll put a link in the description. It can be opened up with a regular savings plan of £50 a month, or a lump sum of £1,000. You can set up auto investing. They have a huge selection of funds and tools to help you choose them. It's easy for friends and family to gift money into the account, and the app's not bad either. There are plenty of other providers to choose from too, so look around and find one that's right for you. A decision also needs to be made about what any deposits get invested in, and whilst this can be a bit of a minefield, there are a number of things that you can look out for to make things easier. Just like the product fees I've just mentioned, keep an eye on the fund fee. One way to keep the fee low is to use passive funds. With these, you don't end up paying the salary of a high-flying fund manager, so the fees are typically much less, and as a bonus, the funds themselves generally perform better. A good rule of thumb is that you don't want to be paying more than 0.25%. Make sure your investment is diversified. It's unlikely that you want to buy lots of a single stock, or even of a single sector. What if that company goes bust, or there's a huge jump in technology stocks like in 2001? Look into funds that invest in hundreds or even thousands of underlying stocks in lots of different areas. These type of funds are essentially doing some of that diversification for you, and in turn mitigating some risk. Make sure you pick investments that are appropriate to your own risk appetite and for the period for which your child's money will be invested. Most funds have a risk rating to make this easier to understand. Multi-asset funds invest in a mix of stocks and bonds. The greater percentage of bonds, generally the lower the risk. Target date funds may also be of interest. They slowly reduce the risk of the underlying investment as a target date approaches by gradually increasing the percentage of bonds in the fund and reducing the percentage of stocks. This will help reduce the effect of any sudden drops in the market right before the money is required. For example, if you think your child's going to want to cash out the investment at 18 to go travelling, you may choose a fund with a target date around their 18th birthday. The Vanguard Life Strategy Fund here is a good example of things you can look out for. You can see the equity to bond ratio, its low fee of 0.22%, and a clear risk rating. If you drill into the portfolio data on the website, you can also see that it invests in thousands of underlying stocks and bonds. Take a look at some of the links in the description below and do your own research to make an informed decision on what's appropriate for you, or alternatively, speak to an independent financial advisor. So to summarise some of the key takeaway points, make an informed decision as to what type of JISA is right for you and your child. Compound interest is incredibly powerful and there's no substitute for time, so make sure you invest early. Inform yourself and make your own decisions. Keep a close eye on fees, they compound just like interest. Make saving easy, automate investing and use appropriate funds if they meet your goals. And if in doubt, seek for independent financial advice. I'll put links in the description to point you in the right direction so you can read up on some of this content yourself. Please like and subscribe, and thanks for listening.